NVIDIA, TSMC, Microsoft, but behind all the flashy headlines is one company, ASML, the unsung hero printing the future of AI. We rate this stock and buy with a price target of $892 or a conservative 19% upside. Now, our investment thesis is based on 3 pillars. One, a monopoly position coupled with a brand new $400 million premium product that's going to ramp revenue like crazy. 2, long-term structural demand driven by the rise of AI, EVs, and global chip reshoring. And 3, the simplicity of the industry, offering a very interesting market entry point. Now, with all that in mind, let's get into what this company is all about. ASML Holdings is a Dutch multinational that sells lithography machines to microchip manufacturers. Their product portfolio includes their installed base management, inspection tools, and DUV, deep ultraviolet lithography tech. But their crown jewel is actually EUV, extreme ultraviolet lithography tech. But what is it? Lithography is the process of using UV light to imprint designs onto silicone wafers, which then become microchips. Things like AI and advanced computing can't happen without EUV lithography. In fact, ASML is the only company in the entire world that creates the EUV lithography machines. They recently came out with high-NA EUV, a further upgrade to EUV lithography, and it's serving as a massive growth catalyst this year.
Now, the semiconductor industry is expected to exceed $1 trillion by 2030, and at the core of every single chip manufacturer is lithography, which is where ASML dominates. Meanwhile, the semi-cap industry is growing at a 7% CAGR, and right now ASML's machines are being used to facilitate the creation of everything from the H100s that train ChatGPT to the logic behind autonomous vehicles. Additionally, we're already seeing the impact high-NA UV is having on productivity. Intel reported that with high-NA, they're able to cut production steps by 75%, going from 40 steps to just 10, a testament to how this technology is about to revolutionize precision and yield.
But lithography spans further than just the tech industry. It's also geopolitical. Recently, the US government put pressure on the Dutch government banning EUV exports from ASML to China. This is because the US wants to maintain dominance in the AI industry, and it serves as a geopolitical choke point towards China.
All right, now let's talk competition, or really the lack of it. As you mentioned, ASML is the only company selling EUV tech, so it's a monopoly in that space. As for DUV, it dominates over 80% of the market share. So looking at forces, most of these threats are pretty insignificant. Consumer supply power may be a little bit more threatening because these are multi-million-dollar deals, but overall from a Porter's outlook, ASML is very solid. We also ran a quick mode analysis. Main takeaway here, exceptional IP, over 17.4 thousand patents in their ever-expanding catalog.
Now it's time to talk money. In 2024, ASML generated 28 billion euros, 45% coming from DUV sales and 23% coming from installed base management. But here's the kicker. EUV sales made up only 8% of total units sold, but nearly 29% of total revenue.
All right, now let's do some quick financial analysis. So right now, ASML is trading at a premium PE of 31, but that premium is well justified by their strong bottom line and capital efficiency. Additionally, they have a CFROI of 36%, which is 4 times greater than 9% WACC, meaning they're generating significant economic value. We also ran a DuPont analysis and found that over the past 5 years, ASML's averaged an ROE of 49%. And unlike peers like KLA that hit these high returns using excessive leverage, ASML's returns are really grounded in their own operational strength and not just debt. With that said, their asset turnover rate is a bit lower than peers, but that's justified by the fact that their assets are extremely long-term and highly specialized. What we really want to drive home here, though, is that exceptional net profit margin that allows them to attain that amazing ROE and outperform across cycles.
Now time for the best part of the presentation, the growth outlook. ASML's revenue is expected to increase by 61% in the next 5 years. Additionally, EUV sales from last year to this year are expected to grow from 8.3 to 11.7 billion euros, driven mainly by a 210% increase in high-NA EUV alone.
All right, now on the risk side, ASML maintains a pretty conservative capital structure with a 27% debt to capital and an A+ credit rating. Additionally, they have a pretty modest cost of debt at only 4.25%, and a comparatively low beta, which indicates a little less macro exposure than many of their peers.
And of course, we can't overlook R&D either, because for ASML, innovation is their business model. They put about 15% of their total revenue towards R&D each year. Last year, that totaled out to be 4.3 billion euros. This ensures a strong technological moat and keeps them significantly ahead of any competition, especially coming out of China.
All right, now to arrive at a defensible valuation, we use a blended approach between a DCF and EV/EBITDA multiple. Our DCF was more conservative, using midpoint EV assumptions, and yielded a share price of $806. We do note that DCFs are incredibly sensitive to inputs, especially changing net working capital, so we grounded that data to projections from GYIS analysts. But even with these credible inputs, ASML's free cash flow still has significant nuance because their product payment timeline often extends across multiple fiscal years. And I'd love to return to that concept in questions, but that told us that DCF alone wasn't the most optimal valuation strategy.
So that's why we complemented with the EV EBITDA model. Historically, ASML has traded within the range of 17.5x and 35x EV over EBITDA. For our valuation, we chose a 24x, just below the 5-year median and today's trailing multiple. Additionally, we believe this really well captures the value of the EUV monopoly, high NA growth catalyst, and technological moat.
Then we weighted that EV EBITDA valuation 65% because oftentimes short-term earning visibility is stronger than long-range cash flow forecasting, so that gives us a final weighted valuation of $892 for a 19% upside.
So if ASML is this dominant, why isn't the market already pricing them higher? Well, to begin, investors are too overly focused on these short-term industry cycles. ASML, just like all other semi-cap names, is prone to changes in foundry capex. Capex decreases, orders dip. But that's not the full picture. Semiconductor demand moves in waves. Demand rises, overproduction occurs, and corrections follow.
Right now, we're in that correction phase, but the structural drivers, AI, advanced nodes, sovereign fab investment, they're all accelerating. Additionally, ASML's 36 billion plus euro backlog is still intact, and they have high NA EUV about to enter a multi-year round that's about to revolutionize the semiconductor manufacturing industry as we know it. So again, the market's overly focused on these short-term working capital swings and capex pullbacks, while ASML is executing on the roadmap for the next decade of computing. And that disconnect, that's our edge. When we first called out this stock, it was sitting around 600, and we told you to buy the dip. Now it's already hit above 750, but there's still runway to be realized, so we ask you now to join us and ride the ramp as we push towards 800.
So now I'm going to quickly go over some of ASML's risks and how they're mitigated. First, export controls. The Dutch government has placed a significant number of export controls on both DUV and EUV exports, specifically to China. However, the most valuable product line, EUV, remains unrestricted to other key clients in Asia. For example, TSMC in Taiwan and Samsung in Korea. Additionally, we already factored in these export controls into our valuation, and it remains pretty attractive.
All right, now we may be wondering if China can't buy ASML's EUV systems, why don't they just make their own? But right now, that's just really infeasible, especially because they're cut off from critical manufacturers like the CO2 laser manufacturer, Trump. And that's Trump with an F at the end, but that is a nice segue to our next topic. We can drop the F and talk about Trump and his tariffs. Right now, they're just really adding a lot of uncertainty to the game. But here's what we do know. Total volume of sales probably won't be that affected because of the inelasticity of demand at this scale. However, we probably will see some margin compression as cost of goods sold goes up. But keep in mind that if the US is actually committed to chip reshoring, they need ASML's lithography machines to be sold to IDMs and foundries like TSMC and Intel, which are building these massive fabs in Arizona and Ohio. So ASML actually get some leeway on tariffs. But then again, we're not certain, right? There's no certainty right now. So that's why we have that DCF serving as a conservative grounding tool to anchor our valuation.
So I'm going to quickly go over the management and governance. On screen, you'll see Christophe Fouquet, excuse my pronunciation. He's over 25 years in the semiconductor industry, and he is very well fit to be the current CEO. Additionally, you'll see the top shareholders and stakeholders of ASML.
Now for a quick ESG analysis, ASML is a very forward-thinking company. I think that's really fitting because they really are the future. They've met and exceeded all of their carbon goals ahead of schedule. They have a very diverse workforce, 148 different nationalities in the 44,000 employee workbase, and only a 3.8% attrition rate. Additionally, strong governance, strong whistleblower policies, and no fines as of 2025. So a very solid company from an ESG standpoint.
And to quickly go over AI, ASML is already enabling it, but they're also implementing it internally. Tools like ChatGPT and Microsoft Copilot have significantly boosted productivity as per their reports.
Great, thank you so much. Welcome to any questions.
I could ask the first question. Their orders, it takes a while for the order book to develop. All this volatility around tariffs, around geopolitics, around who can buy what from whom, how's that impacting their orders and their backlog? Because, you know, these plants in the US may not even have to an exchange, so
Yeah,
how's that
exactly.
impacting their business?
Yeah, so there is quite a bit of volatility. Right now, in the first quarter, actually, ASML missed bookings. I wouldn't say that's an indication of what their bookings will look like going forward in this year. We'd have to see a decline in bookings for probably at least 2, probably even 3 quarters to make a very justifiable claim for bookings declining. But there's definitely is volatility, especially around these news. But I think right now, we just have to wait for more information. I think to make a claim on how bookings or orders will evolve before we get more news about what is actually being implemented would really not give us a very reliable evaluation of their orders.
One thing we saw with semiconductors during COVID was people were scrambling for chips, and when they needed 2, they ordered 10, hoping that they might get 1. How do we know that the same thing hasn't been happening in the lithography business? People are indicating future demand. Maybe it's really not going to crystallize.
To clarify, are you talking about on the consumer front, so like the front end for chips, or just the?
I use the example of chips, but I'm seeing if maybe we should extend it to the lithography machines themselves.
I see.
I think from more of like a consumer standpoint,
I can jump in here. So I definitely do think demand is strong for TSMC and Intel, because ASML's machines are integral to their strategy. No matter what, they need ASML's machines for anything they want to accomplish. So I really don't think there is faux demand. I don't know if that's the right term there to use. I think it is all solid and well justified by the fact that these chip manufacturers need ASML's machines to continue their growth, their innovation, and their sales growth.
And the point I want to add is that ASML is pretty far up the supply chain, so these businesses, it's all B2B, right? So if TSMC say they want a lithography machine, they're very cost efficient, and I'm sure they won't buy more than they actually need. So the demand that the demand should be, I guess, very, I don't know the exact word for it, but you know, it won't be excessive.
Great.